Okay, welcome back, guys. Okay, welcome back. Let's just do this question, and then just gonna do one question. Okay, and then after this question, we are done with the lessee, and then maybe tomorrow, I don't know when, we're gonna do the lessor. So when we do the lessor, now you will be having the knowledge about the lessee and then the lessor. So we're gonna do a lot of questions now from in the next videos. Okay, so for now, let's just do this one question. So let's do it. Here is what is happening. Finance lease agreement in respect of the heavy duty truck. So this agreement was entered into on 1st September 20.1. Okay, was entered into on 1st September 20.1. Okay, the terms of the lease agreement are as follows: the cash price of the vehicle is actually 920,000 including VAT, and then the 6 payments of 184,165. Okay, so ownership of the truck will be transferred to the lessee at the end of the lease term. So let's stop here and analyze. Okay, because we have a lot to analyze from this. Okay, let's just read the whole question, because I think I see something. Okay, the first payment will be made. The first payment will be made on 28 February 20.2, and subsequent payments will be made every 6 months thereafter. Okay, the useful life of the truck is actually 5 years. And then we have 25% residual value on original cost. Okay, and then the deferred tax is accounted for in terms of IS 12. Deferred tax is accounted for in terms of IS 12, and the current period tax rate is actually 28%, and the VAT it's 15%. Okay, and the year end is 30 June 20.2. Okay, so now we need to analyze this thing. So it says the cash price of the vehicle is 920. What is this thing? This is the fair value of the vehicle. Fair value of the vehicle. Okay, and the ownership of the truck. The ownership of the truck will be transferred to the lessee. So if the ownership will be transferred to the lessee, two things should be coming into your mind now if you know your IFRS 16 very well. Firstly, you are not expecting to see any unguaranteed residual value in this question, for the fact that the truck will be owned by the lessee at the end of the lease term. So we are not expecting any unguaranteed residual value in here, number one. And number two, if we had any option to extend or any option to terminate, we would assume, or we would be sure, that the lessee will exercise the option to extend, or the lessee will not exercise an option to terminate. Okay, this one sentence tells you a lot of things. Okay, so it doesn't matter that those things are not here in this question, but it tells you a lot of things. You need to be able to analyze it in that way. Fine. Now let's do this. We all remember what an implicit rate means. Okay, so here we are not given an implicit rate, but we need to first calculate the implicit rate. Okay, so it is the value, or implicit rate is the rate that causes the present value of lease payments. The present value of lease payments, here's the lease payment. The present value of lease payments, okay, plus unguaranteed residual value, which we do not have in this question. The present value of lease payments plus unguaranteed residual value, which we do not have in this question, to equal the fair value of an asset. okay, plus initial credit cost, which we do not have. It means now we can calculate the implicit rate because we know it is the rate that causes the present value of lease payments to equal to the fair value of the asset. So it means, and we know we have n. Our n, it said 6 payments, so our n is 6. Okay, we only have I. Our PMT, which is the lease payments, it's 184, 165. Okay, and the FV, which is it's either the unguaranteed residual value or the guaranteed residual value, which we both do not have, it's 0. Okay, and the present value, which should be the present value. Remember what the rate, that definition says. It says the present value of lease payments. The rate causes the present value of lease payments to equal the fair value of the asset. What I said to you earlier is that this means that the fair value of the asset equal to the present value of the lease liability. In this case, which is 920,000. Okay, so we need to compute I. Use our financial calculator to compute I, which is 5.5%. Okay, remember this 5.5%, this is semi-annual. Okay, so to make it annual, times by 2 and we get 11%. Okay, that's it. So now we know all these things. What's the next step? Let's find the right of use asset. Okay, so the right of use asset in this instance, it should be 920,000 multiplied by 100 over 115, because we are taking the VAT out now, and this should give you 800,000 rand. Okay, so remember we need to calculate the depreciation. We know the cost is 800,000 and they said the residual value is 25%. So let's say 25%, we multiply by 800,000. Okay, this should give us 200,000. Okay, so it means now the depreciable amount is actually 800,000 minus 200,000, which equals to 600,000. Okay, and then we need to depreciate this. Remember when we're doing the subsequent measurement of ROA, it said the earlier of useful life or the lease term, and the lease term here, it's what, it's 3 years, because 6 payments which will be made over 3 years. Okay, so we divide that by 3, and then we multiply by, sorry, give me a moment. Okay, sorry for that. And then we multiply by 10 over 12. Where do I get this 10 over 12? So the end is 30 June 20.2. Okay, and we are on 1st September 20.1. So if you calculate months from 1st September 20.1 to June 20.2, you should get 10 months, which is September, October, November, December, January, February, March, April, May, June, which is 10 months. And then you get your depreciation. Okay, so that's 600 over 3. Okay, and then you multiply by 10 over 12, and then you get 166,667. Okay, that is the depreciation. Now let's go to a lease liability. This is the ROA. Okay, this is the ROA. This is the ROA. So now let's talk about the lease liability. We know on 1st September, we know that on 1st September we have a lease liability of 920,000 rand. Okay, so we need to calculate interest expense. So that interest expense, you need to be careful here, because this thing, it's semi-annual. Okay, and we are making a payment on on 28th of February 2022. So we need to say multiply by 5.5%. Okay, because this is for 6 months. Remember, this is for September. Okay, September, October, November, December, January, February, which is 6 months. Okay, and then we get 50,600. Okay, now we need to, that is for the first 6 months, and then the second 6 months. Remember, the second 6 months starts on March, April, May, June, but it's actually gonna be 4 months because our year ends on June. Okay, so we know that we have 920,000 liability. We need to plus, sorry, we need to plus the interest expense of 50,600, and we subtract the payment of 184,165. Okay, this should give you, this should give you, okay, this should give you, it's 920,000. We add the interest of 50,600, we subtract 184,165, the payment that we made on the payment that we made on February. We get 786,435. Okay, and then we multiply this thing by 5.5%. Now that 5.5% then times by, because we have 4 months of this 6 months, then this should equal to that multiplied by 5.5% over 100, and then you multiply by 4 over 6, which should give you 28836. Okay, so your interest expense now, it's actually this 2 plus this 50,600, so it should be equal to 79,436. Okay, so now I think we have everything. You know what is your lease liability at the end, which is, we know we opened with 920 plus 50 plus okay, actually it's 920 plus 79 minus 184, then that gives you a closing balance of the lease liability. ROA, it's 800 minus the depreciation, it gives the closing balance. Okay, now my focus is on calculating the deferred tax, temporary differences. Now temporary differences. Okay, so we need to add back depreciation. Okay, need to add back depreciation of how much? Of 166,667. Okay, we need to add back interest of 79,436. Now we need to subtract the lease payments of 184, 165. Okay, now we need to add back the notional input VAT, How do we calculate that? We say that we have 184, 165 payments multiplied by 6, which is the total payments. It's actually 184, 165 times 6, which is 104,990. Okay, So to get that notional input VAT, we need to say 184, which is one payment of 165. We divide by the total of 104 990. We multiply by the VAT. Remember how much the VAT is. We said the lease liability, the lease liability is 920. Okay, then we took out VAT. It gave us 800 of the ROA, which means it is actually 200,000 input VAT, the input VAT. So now the notional it's 184,165 divided by 104 990, and then you multiply by that by 200. Okay, and then we get that amount. So let me confirm one thing. No, sorry, the 920 minus 800 should give you 120. Sorry, my mistake. Should give you 120. Okay, and then we say 184,165 divided by 104 990 multiplied by 120. You should get 20,000 rand. So the notional input VAT should be 20. We add back 20,000 rand. Okay, so now if you say this plus this, let's just do it. 166 667 plus 79 436. Okay, and then you minus 184,165. You add back 20,000 rand. It gives you a temporal difference of 81,938. This is a deductible temporal difference. Then if you multiply this by 28% now, if you multiply this by 28%, it should give you a deferred tax asset, okay, of that much. And that's all that I wanted to talk to you about when it comes to deferred taxes and VAT. And if you did not get what is happening here in this video, don't stress too much. We still have leases to do. So after leases, we're gonna do a lot of questions on leases, and those questions I think should help you to understand the VAT with the deferred tax implications. Okay, so for today, let's just end here and hope for next time. So do not forget to subscribe to the video, and do not also forget to write your comments, ask questions, recommend, and do whatever you feel like doing in the video. Okay, so for now, thank you guys.